Hello guys, we're from Group 5 and today we're gonna talk about the case 7.65. My name is Muhammad Fathi Ramadhani.
My name is Muhammad Rizky.
And my name is Muhammad Aubin.
Okay, next. So this is the case 7.65. It's about cost volume profit with multiple products, sales mix changes in fixed and
Variable
variable.
costs. So we begin to the first question. The first question is calculate the number of grade 1 and grade 2 cabinets that are expected to be sold during the current year. So the answer is
The answer is there are cells for grade 1, and this is the equation unit sold multiply by unit price.
okay.
Next is the number we're gonna insert insert the number, and the grade 1 is 10,200 times by x.
Okay. So and for the sales grade 2, same formula, unit sold times by unit price. It's 11,200 multiplied by x. And there are the formula, and the x is
74,766.355.
so the number of grade 1 sold is 3 multiplied by 74,766.355, and it's equal 224,299.0654.
And grade 2 is 7 times by 74,076 point 355, and it's equal to 523,364.45 485.
That's
Next,
the first question, and
Next to
we
the second
second
question.
question.
Is calculate the number of grade 1 and grade 2 cabinets that must be sold for artistic to break even.
so the answer is revenue equal variable cost plus fixed cost, and
This is the equation,
yes,
and the number insert.
and the number of x is
Yeah.
for 46.557, and the number one of great salt is 400 46.557 multiplied by 3, and the answer is 140.
And the grade 2 is 46.557 times by 7, and it's equal to 326.
Yes. So that's for the second question, and we move to the third question.
Okay, so the question, artistic can buy computer-controlled machine that will make doors, drawers, and frames. If the machines are purchased, the variable cost for each type of cabinet will decrease by 9%, but common fixed costs will increase by $44,000. Compute the effect on operating income and also calculate the new break-even point. Assume the machines are purchased at the beginning of the 6 months. Fixed costs for the company are incurred informally throughout the year.
The answer is financial impact of machine purchase is number one is the current metrics. Sales price per cabinet is $200, and the variable cost per cabinet is $120, and the fixed cost is $100,000, and annual sales volume is 1,000 cabinets. The number two is changes after machine purchase. The variable cost decreased 9%, and the new variable cost is 109 and point 20, and the contribution margin is the new one is $90.80, increases due to lower variable cost, and the last one is fixed cost increase $44,000, equal to $144,000.
And the next we're gonna operating income impact. So the current operating income is minus $20,000. It's loss, and the new operating income is minus $53,200. It's greater loss, and decrease in operating income is minus $33,200 due to increased fixed costs. And the last one is break-even point. Break-even units is 1,588 cabinets, increase due to higher food costs.
And that's for the third question. And we move to the last question, question number 4. And the fourth question is revert to the original data. Artistic is considering adding a retail outlet. This will increase common fixed cost by $70,000 per year as the result of adding the retail outlet. The additional publicity and emphasis on quality will allow the firm to change the sale mix to one. The retail outlet is also expected to increase sales by 30%. Assume that the outlet is open and at the beginning of the 6 month. Calculate the effect on the company's expected profit for the current year and calculate the new break-even point. Assume that fixed costs are incurred uniformly throughout the year. So the answer is
So,
Uh,
after we analyze the case question, it comes to the current metrics, which is the sales price is $200, and the variable cost is $120. Fixed cost is $100,000, and the sales volume is 1,000 cabinets. So that you
okay, then.
proceed.
Second is number two is changes in new fixed cost. So the new fixed cost is 100,000 plus by 70,000. So it's 170,000 fixed cost.
and
The
the sales new sales volume become 1,300.
And the expected profits is the total contribution margin. So the total contribution margin become sales price minus by variable cost times sales volume equals to 200 minus 100 minus 120 times 1,300 equals to 104,000. Uh, okay.
and
And the answer is
Yeah.
104,000. And now the operating income operating income is uh total cost margin minus
fixed
fixed
cost
cost
new
new equal 104,000 minus 170,000 equal
minus.
minus 66,000.
So the new break-even point is 170,000 divided by 80, so it's 2,125
Yep.
cabinets.
So that's all from us.
Yeah.
Thank you for
Thank
everyone who
you.
pay attention
Thank you guys.
with our presentation. Assalamualaikum warahmatullahi wabarakatuh.
Thank
Bye
you.
guys.
Bye.